This is Sovereign Debt, a podcast on greening the global economy and debt sustainability. I'm your host, Jill Doshi. Hello, everyone. I imagine that everyone is back in the swing of things. It is the week of the UN General Assembly and Climate Week up in New York. The annual meetings are fast approaching, and I think all of our summer tans have faded and we are back at work. So to kick off this new season, we have a very special guest who is well known to all of you. Brad Setzer is an economist at the Council of Foreign Relations, also formerly of U.S. Treasury and Rubini Global Economics Monitor. He is also importantly the author or co-author of Bailouts and Bail-ins with Nouriel Roubini, which I'm sure is a book that all of you have on your shelves. And Brad just told me that it's out of print. So call your publishers and contacts and tell them to get this back in print. It's important. Brad, thank you so much for being here today.
Oh, thanks, Jill, for inviting me. And thanks for reminding me that I wrote a book almost 20 years ago. So.
It's still a go-to volume, I think, for all of us in this field. So, Brad, it's an understatement to say these are really challenging times right now out there. You're someone who understands the big picture, and importantly, also the big economies, US, China, Europe, etc. I'm always out there on the frontier, as you know, but you're always right in the middle and in the thick of it. And yesterday we had the Fed raising rates again, 75 basis points again. Russia also announced that it's upping its troops or calling up 300,000 reserves and looking like it's going to try to officially annex some of the Russia-controlled territories in Ukraine, which might give them extra leverage or God knows where that might lead. There's many countries being blocked out of the capital markets, just an enormous amount of things going on. Could you walk us through some of just the basic implications of some of what is happening, or just kind of set the scene a little bit for us?
Sure, I can try. It's obviously a fairly unique period in time, particularly because of the Russian invasion of Ukraine. And the way I look at it is that the world was still in a lot of ways recovering from the shock associated with the pandemic, the direct shocks from the pandemic and the disruptions that generated. And the pandemic obviously produced a gigantic policy response that interacted in not completely easily foreseeable ways with some of the underlying disruptions caused by the pandemic. And the world was working its way out of that mix when a new shock got layered on. That new shock obviously is a shock to global energy markets from Russia's invasion and the subsequent boycott of Russian oil. And then for those markets that rely on traded natural gas, in Europe in particular, there's an absolutely enormous energy shock. And then on top of that, there's been a fairly synchronized global slowdown over the past several quarters. The US obviously has slowed. Europe is clearly slowing, if not going into a recession. China slowed substantially, partially because of the property downturn, partially because of the COVID outbreak and its implications. Yet, even with like a fairly synchronized slowdown, there's been an important divergence in policy. China's loosening. The Fed, because of the level of inflationary pressure, is tightening quite rapidly, as you noted, and he is following the Fed. So I think that's generated shocks to capital markets, shocks to product markets, shocks to energy markets that are impacting almost the entire world, but particularly some emerging economies.
Yeah, exactly, because the predominance of the US dollar in all of the trade, as well as so much of the actual debt instruments are denominated in US dollars. So that immediately increases the price of everything for emerging markets. But then when we're thinking about Russia, I mean, it's a very kind of really kind of small player, so to speak, in the global economy, except for the fact that it's one piece of the global economy is so important because of the energy prices or the energy supply. Correct. So this has this like massive impact, just ripple through the entire system.
I mean, Russia is by emerging market standards a large emerging economy. By global standards, it is a small economy. And inside the energy market, it is a superpower. It produces roughly 1 in 10 of all barrels of oil that are pumped out of the ground. Its impact on traded oil is much greater. It's only slightly behind Saudi Arabia, and it is the biggest natural gas exporter, counting pipeline and LNG gas, and it has been absolutely essential to the energy balance inside Europe. And I think the key source of its global disruption is the fact that without relatively cheap Russian natural gas, the natural gas market in Europe balances on the back of expensive, globally traded LNG, which has pushed up the price of gas in Europe to extreme levels. Gas trades at a huge multiple to oil, when intrinsically gas should trade at a discount to oil. Since natural gas was the marginal source of electricity to much of Europe, and pricing, because of the way the market was structured, depended on the marginal price in general. I mean, I think that's changing. There's been pressure on the wholesale price of electricity throughout Europe. And, obviously, France's difficulties generating nuclear power only added to the shock. But it's hard to overstate the scale of the energy shock that is facing Europe in particular. It's clearly of similar or greater magnitude to the oil shocks of the 1970s. And then those emerging markets who previously had relied on traded natural gas, LNG, have basically been priced out of the market. Coal prices are up too. I mean, it's sort of it's a much broader shock than simply an oil shock, and that's Russia's true impact on the global economy.
And in some ways, I mean, not to veer off into kind of geopolitics and Russian history, which I could definitely go down that rabbit hole for quite some time, but this is in some ways Putin's way of reminding the West, broadly speaking, of its importance, right? In some ways, I mean, you were saying that as a global economy, it's quite small, and as an emerging market, it's quite large. I think Russia has always been kind of a little bit unnerved by being lumped together with other emerging markets, and whereas it sees itself as a much more important global player. In some ways, I think all of what's happening now is to kind of reminding the world of its place at kind of the central table, so to speak.
Certainly trying to. I mean, it's also obvious that Putin believed that his leverage over Europe's natural gas supply would give him political influence over European policy, and it's not clear that that's succeeding. But it is clear that Putin had the ability to impose some significant economic cost on much of, actually almost all of Europe, and then to a more modest extent on all countries that relied on imported oil or that are connected to the global oil market. The big forward-looking issue is that the EU is trying to disconnect through an intensification of its sanctions from Russia's tanker-supplied oil, which is a potentially significant disruption. And then to add to it, and something obviously the U.S. Treasury has been emphasizing, the European sanctions as currently constructed also would prohibit the use of European insurance and financial services more generally for the shipping and transport of Russian oil even if the end market was not in Europe. So that, if implemented, or even if the implementation of the proposed price cap, which is an exemption to those sanctions, goes forward, there's a potential period of disruption to the oil market, to hanging out there in December.
As you say, I don't think Putin really kind of anticipated that Europe was going to kind of be as strong as it has been, and to act in this way. And I think, and another event that we didn't even mention in the opening was of this week was the meeting of India and China with Russia. And I think the messages coming from those leaders were also that this isn't going the way they want it to go, and that they're also unhappy. So it really seemed in some way that Putin was a little bit more isolated, and what he does from there, like how he reacts, in a variety of ways. I again, I shudder to think, but anyway, it seems like it's not going to plan.
Clearly, it has not gone to Putin's plan to date. Unfortunately, it doesn't look like Russia's yet ready to give up, and so the Russian shock to European energy markets will continue, and there will be ongoing questions about the availability of Russian oil to the global market, and the ability of the rest of the world to make payments to Russia, given that obviously the biggest remaining external source of income for Russia stems from the proceeds of its oil exports. So it's a natural target for sanctions, but it's an extremely hard target for sanctions, because taking oil off the market hurts oil consumers generally, and it tends to raise revenues, all else equal, for producers. So it makes Russia a difficult target. But as long as Russia is kind of committed to finding a military outcome in Ukraine that meets Russia's objectives, those objectives are incompatible with the goals with Ukraine's sovereignty and with U.S. and European policy. So the tension will remain, and the fallout globally is quite significant. I mean, India's ongoing imports of Russian oil are sort of a constant reminder that India, which broadly speaking hasn't tilted strongly towards either Russia or Ukraine in a geopolitical sense because of India's past connections with Russia, and India's certainly been willing to import Russian oil at a discount, but that's its continued ability to do so, and the terms on which India and other countries are able to access Russian oil is going to be a big part of the global economic conversation over the next few months.
I was going to say, and then, I mean, and that kind of increasingly will put them at odds with the US and EU and others, presumably.
I mean, it depends. I mean, if Russia agrees to sell India oil with the making use of European insurance under the proposed low price exception, everything will work fine. The U.S. has indicated that if India arranges its own insurance, but it's getting Russian oil at a deep discount, that's fine. But if India is paying close to the market price, and that is contributing to ongoing Russian revenue, at some point that does potentially become a source of tension. And I think India is just a stand-in for a set of countries around the world that aren't the US, that aren't in the EU, they aren't the UK, they aren't Japan, they're not the G7, and they're not China. Their fundamental interest is the old-fashioned, simple interest of most participants in the global oil market, which is getting access to a secure source of supply at a price they can afford.
Well, and if we think back to like the original kind of statements coming out of the UN about the invasion at the time, there was quite a few countries that just kind of abstained or just were kind of no comment on it, and I think that's stemming from that, is that they have a very complicated histories with both Russia and the West or the US or Europe, and like you said, are just also just looking out for themselves and just saying we're going to need them, whether that's oil markets and in some cases also kind of defense contracts and the like. So that's all a mess, um, to put it in a Jill sort of way. And China, can you help us kind of think through where we are, where we're going? You mentioned obviously that their policies have taken them in a different direction because of COVID and what they're experiencing domestically, but also in our world, they're also the largest creditor out there to basically everyone through their Belt and Road Initiative and just in all ways. Can I just ask you just like the broadest of questions of what do you think? help us put some of this in some sort of context, and then we'll dig a little deeper.
Probably starting in 2010, so even a little bit before the formal launch of the Belt and Road, China made a very clear policy decision that it had more than enough foreign exchange reserves, and that at the margin it was going to direct its external asset accumulation through the state banks and radically increase its lending to sort of a range of emerging markets. Some countries that were a little higher on the income scale that had resources that China found, believed were important. So there was a component of Chinese lending that went to Russia, actually, to help Russia build out some of its traded natural gas infrastructure and the like. But there was also an enormous increase in lending to a wide range of low-income countries all around the world. Generally, countries in strategic locations or countries with important resources for the Chinese economy. So the lending was not equally distributed, but the sums were quite considerable. So between 2010 and 2020, China provided at least $500 billion of credit to the emerging world, probably more than that, primarily through its two policy banks, the Export-Import Bank of China and the China Development Bank. But it never was completely transparent about the scale of its lending. And so there's unfortunate uncertainty about the true exposure of China to the world and of certain countries to Chinese creditors. And I think that wave of lending, certainly financed a wave of infrastructure construction that might not have happened without access to Chinese financing. But it also left a number of countries with debt that is either unpayable on the scheduled time frame or simply unpayable, period. And so we've moved into the kind of, we've gone from boom to bust. The amount of Chinese lending has been scaled back quite significantly. China is now negotiating over payment terms with a broad set of countries, sometimes directly with the country, sometimes through a still developing architecture for coordinating the restructuring of Chinese policy bank lending with the lending of other institutions and bond market debt.
Yeah, I think they're still trying to figure out what they want and how they want to approach this. It seems that they're treading, they are moving forward, but treading carefully. So I know that you've been watching, well, we all saw the news out of Ecuador that there was this new deal that has been reached, also the news of this week, as well as some progress on Zambia, where they've agreed to co-chair the official creditor committee with France. Same thing in Ethiopia, although there we have probably less progress due to ongoing conflict there. So do you feel that China is willing to kind of step up and be kind of a global player and coordinate with other creditors? From your perspective and what you know of the country, do you see that that's the trajectory, or is this still kind of clouded in kind of uncertain terms and just on a strategic and kind of, like I say, kind of not clear terms for the rest of the world?
I mean, I think, in some sense, China has been forced to step up and participate in globally coordinated restructurings well before China itself was really ready to do so. And so I think a lot of the difficulties have come because China hasn't really had a choice. It has to participate in the restructurings given the scale of its exposure and the scale of others' exposure. But it never really had built out institutions for it hadn't really defined the set of restructuring terms that would be acceptable to its own policy banks. And it certainly hadn't completely figured out how the restructuring of the policy bank's exposure, and to some degree the state commercial bank's exposure, would fit together in a globally coordinated way. And in that sense, the Ecuador and Zambia comparison is, I think, relatively helpful. Ecuador clearly was an uncoordinated restructuring in the sense that China's restructuring took place at a different point in time than the restructuring of other debts. It wasn't coordinated with the Paris Club, nor did it need to be, given the economic circumstance. It wasn't coordinated with the bonds. And this is actually, in some sense, China did a small rescheduling back in 2020 when oil prices were low, and those terms were, they created a problem this year and next year by piling on a lot of amortizations into a small period of time. And I think the deal that was just announced sort of smoothed out what otherwise was a very clear hump in amortizations, gave Ecuador a few more years. We don't quite know the interest rate, but maybe Ecuador got a little bit of a break on the interest rate. But it still left Ecuador with pretty substantial payments to China, certainly before this rescheduling was announced, and even going forward. This is most of the rescheduled debt will be fully paid off by 2030. So there's a pretty steep amortizations even after this deal. So it's
kind of, like you say, it's kind of smoothing out the payment schedule. It's not really providing, and not knowing the exact details, but it's not really providing debt relief, or there's no haircuts involved. It's just kind of pushing it out a little bit.
That's true, but I think in the context of Ecuador, Ecuador is an oil exporter. Oil prices are relatively high. The cash flows allowed for a more modest debt treatment, and China has consistently negotiated directly with Ecuador. It hasn't tried to fit its rescheduling into a broader internationally coordinated program. So there's a real risk that even the reprofiled amortization schedule will interact with the bond restructuring, which was also wasn't a deep haircut. It also piled up a decent amount of debt service over the next 10 years. So there's going to be the classic problems that Ecuador always faces, which is that it doesn't have so much debt that it obviously needs debt reduction after having gotten debt reduction in the past, but it has enough debt that it tends to get into trouble if oil prices are too low, given the structure of its economy. And that basic problem is going to remain. But what's, I think, interesting is Ecuador fits into the traditional pattern of a debt workout with China. It was negotiated bilaterally. It didn't involve any real reduction in principal. There's a sequence of rescheduling. So first China pushes out payments for a year or two. And then if that's not enough, then there's a more comprehensive rescheduling that gives 5 to 10 years worth of payments. but it is all negotiated directly with the two big Chinese banks. And it isn't part of a globally coordinated change in terms. There's no attempt has been made to equalize the debt relief provided by China and the debt relief provided by the bondholders in the bond exchange back in 2020. They are very separate transactions. Zambia is in a sense the complete opposite. Is an attempt to bring the restructuring of Chinese claims into the traditional architecture of restructuring low-income countries' debt. And that also has been a very slow, torturous process. It has taken, Zambia defaulted in late 2020, defaulted on bonds, but also defaulted on most of its Chinese lending. And it's taken close to 2 years to get a comprehensive accounting of how much Zambia owes various Chinese institutions, counting the loans taken out by Zambian state enterprises, and to get agreement on what part of China's lending falls in the official bilateral bucket and will be restructured in parallel with the Paris Club, and what part of China's lending to Zambia is going to be considered commercial lending and will be restructured in a separate process. So it's just taken a really, really long time to sort out some pretty basic questions like where will, in what process will the debt Zambia owes to the China Export-Import Bank and the China Development Bank to ICBC, a big state commercial bank, which has a decent amount of exposure to Zambia, where will that be restructured? Will it be part of the official bilateral restructuring, or will it be separate? But it does seem like there is a tortured agreement that puts most of the Chinese lending in the official bilateral bucket. And China has agreed, at least in principle, that its terms, by which effectively, there isn't an it with China, it's multiple balance sheets, but those terms, at least in principle, will be consistent with the IMS program, which clearly implies some MPV debt reduction. And then that will be carried over in some way to the bond restructuring and to the restructuring of the part of Zambia's debt that is still considered to be commercial.
Do you think part of the very long delay, you mentioned these kind of 2 years of negotiation, is that delay kind of like only going to be like a one-off sort of delay, in the sense that this was the first case and that China was confronted with having to make all of these decisions, and as well as the other creditors around the table to kind of negotiate, as you say, which entities were what sort and what camp are they kind of official creditor, or are they more commercial lenders? Do you think that Zambia, just unfortunately for them, just by nature of being the first, was the slowest because they had to kind of work out all of these kind of issues? Or do you think that this is kind of a new feature of this problem, of this coordination, and that this is just going to continue to be tricky because each case is a little bit different for China, and they're going to be treading carefully of like when and how they disclose the lending?
I actually think the answer is a bit of both. I think Zambia was slow in part because it was the first, and it was setting a number of questions had to be answered definitively for the first time, and they weren't answered in the common framework. And so Zambia became the test case that forced actual answers to difficult questions. But then I also think there's so much ambiguity around how the Zambia precedents or norms, as they seem to be, because we don't. A lot is being inferred from footnotes on page 100 and plus of the IMF's report. But as those precedents or norms are imputed to other cases, there will be difficulties because other cases are not parallel with Zambia. So I think it's probably easiest to explain in the detail rather than in the abstract. So the compromise in Zambia, or the outcome of Zambia, was that the Export-Import Bank of China, all of its exposure is more or less considered to be official bilateral exposure, because Export-Import Bank exposures around the world are generally considered to be official bilateral exposure. And then project lending by the China Development Bank or any of the state commercial banks that benefited from an export credit guarantee from Sinoassure was also considered to be official bilateral lending. So that left some loans from the major Chinese commercial banks, possibly from some of the CDB's loans, outside the perimeter of the official bilateral restructuring because they didn't have the export credit guarantee. If that is the precedent, then it's pretty clear that most Chinese project lending around the world, which will have the credit enhancement from the Export Credit Guarantee Agency, will be official bilateral, even if it is not from the Export-Import Bank of China. There's always howevers. Chinese banks, be it the China Development Bank or the State Commercial Bank, have provided kind of budget support lending or lending to support reserves in other cases. And right now, the treatment of that pool of lending isn't at all clear. It's from institutions that are considered by the Chinese to be commercial. And it doesn't obviously benefit, at least to my knowledge, from an export credit guarantee. So in that sense, some of the same questions that took forever to sort out in the Zambian case will likely be relitigated, which implies some of the same difficulties will be replicated. And then the other potential, other big question mark stems from the fact that, so far China's government has just provided its overall assurance that the restructuring will be on terms consistent with the IMF program. The individual Chinese institutions that actually have to agree to change the contracts and terms of their loans haven't yet accepted, at least not to my knowledge, precise restructuring terms. And so it is completely possible that the process of getting China XM and the CDB and ICBC to sign on to concrete terms, which will clearly imply very long maturities and somewhat concessional interest rates, will take quite some time.
That was you've actually touched on exactly what I wanted to ask you next, because the IMF went ahead and the board has approved the Zambia program, and so they had their financing assurances. So what you're saying is that those financing assurances really just came from China, like from the top level, saying, okay, finally they got to some level of comfort one way or another, or somehow something happened that they decided that they could give the IMF whatever it is the IMF required. But yet what you were just saying is we still don't know actually what the actual relief or the actual deal or negotiation, the outcome for Zambia is going to be. But the question is, would China, in your opinion, would China feel strong enough, or kind of confident enough to give those assurances if it hadn't already figured out that the entities would provide relief?
I think that is going to be the most important question that will be answered by December, whether this was the the finance ministry speaking on behalf of China's government, recognizing that, hey, we can't continue to block IMF disbursement and the publication of the program and any progress any longer. So we're going to agree to provide overall assurances, and then we're going to go talk to the individual creditors and try to get them to explain to them what this means and try to get them to agree, which I think is probably what happened. But the other possibility, which would imply a more substantive financing assurance and a more substantive negotiation has already taken place within China, would be that it is also possible that all the individual institutions had basically seen the overall parameters, had figured out what those parameters imply for their exposure, and had essentially agreed that they could make those kinds of adjustments in advance, in which case the restructuring should now proceed very quickly.
I mean, as well as I do that the kind of the very specific wording of that policy in the IMF is that the financing assurances have to be both credible and specific. So either they just kind of really leaned in on the credible in the sense that China is just going to have the power to make this work and just somehow deal with its institutions, no matter what actually kind of comes out of it. And they just felt comfortable, or maybe under enough pressure themselves, that they had to move forward and they couldn't leave Zambia in this limbo any longer, that they just had to move forward. Or, like you say, that there are actually credible and specific agreements kind of forming somewhere in the process. I guess we'll just have to wait and see how this plays out. But it will have, either way, it has huge implications for the future of the common framework and all of these other countries. So that kind of leads me to my next question. I know we're getting close on time, but the common framework, well, the DSSI was in the same sense of just putting a little Band-Aid on things during COVID and just kind of kicking the can a little bit and saying, here's some breathing room just to get through the immediate. But all of those postponed payments are now going to be coming due very soon, in a moment where things are looking quite difficult for many countries. Do you expect this long-awaited, long-anticipated wave of defaults and debt distress? Or as a first question, then as a second question, do you think that countries are going to start actually raising their hand for the common framework? Or do you think that the kind of fears are still, and seeing how this has been kind of a long drawn-out process for some countries, that they're going to avoid it as much as possible?
Maybe I'll take those in sort of reverse order. I don't think many countries are going to sort of volunteer to preemptively enter the common framework because they anticipate difficulties paying their debts. I think countries will be, in a sense, forced into the common framework because they cannot pay their debts. And the condition for the common framework is the only process available for a low-income country to generate a coordinated debt restructuring. So the country has to go to the IMF. And once it's gone to the IMF, it really has to have a coordinated restructuring between the Paris Club and that portion of the Chinese policy and commercial bank lending that is judged to be bilateral. So there will be more cases, and I don't think it's not a question of whether the common framework will be attractive. It's whether the common framework will produce good outcomes in a reasonable period of time for the broader set of countries that clearly need to make use of it. the obvious case, which is sort of technically just outside the common framework of Sri Lanka, which just doesn't quite meet the income threshold, but it clearly, it's negotiated in an IMF program. There's significant bond exposure. There's significant exposure to the Chinese policy banks. There's significant Paris Club debt outstanding because of Japan. And so it could be, and I think there's a willingness to sort of basically apply to the extent possible the common framework principles to that case.
I think the creditors have said, or the official creditors, certainly the Paris Club, has said as much. Kind of, we can use us as a platform, or use us as the framework for your restructuring. But,
yeah, and then it becomes China doesn't. Since Sri Lanka technically is not a low-income country, China doesn't necessarily have to fit its lending into the principles of the common framework. And the bondholders may say that the low-income country debt thresholds are too binding and too restrictive. So there's it is completely possible that the application of the common framework to Sri Lanka will be contested. And then I think there's a set of countries which right now are kind of mostly negotiating with the IMF and clearly will have difficulties meeting all of their contracted debt in full and on time without financial help from others. But there's a set of cases of countries that are facing obvious near-term distress that are negotiating with the IMF. And in most cases, it seems like the IMF's financing will, in the short run, be available to avoid a near-term restructuring and give the countries more time. So I think it is significant that Pakistan is not restructuring its bonds. And the IMF put in money, the big strategic bilateral creditors, China, Saudi Arabia, also put in money alongside. And for the time being, Pakistan is being given more time and the opportunity to show that it can reform and be in a position to make payments in full. That was a relatively easy decision for Pakistan because Pakistan doesn't have that much bonded debt, didn't have that much bonded debt coming due, and China was putting in new money, so it presumably wouldn't be taking out funds during what was a relatively short program period. I think those decisions become more complicated for some of the other countries that are now negotiating with the IMF, sort of the Ghanas, the Egypts of this world. And it's pretty much, both obviously need IMF financing, and they have slightly different bond payment profiles, but there's a clear question about how the bonds will be handled in the near term. And I think there's a near certainty that if the initial round of IMF financing doesn't provide enough breathing room, that the second round would, as is classically the case, would be combined with a restructuring. So I guess my general view is that we're not yet on the wave, a new wave of default, because there's enough IMF financing in train to avoid that wave for the very near future. But if conditions don't change, whether because of reforms and adjustment in the country or a broader shift in global financial markets that makes it easier for indebted countries to raise money externally, then 2 years down the line, the same questions will be asked, and there probably will be more restructuring. So right now, the general observation one thing that has struck me as a general observation is that the path towards default recently has played out in a pretty orderly way, in the sense that there were payments looming. They were mostly payments to bonds in China. They could be seen. The countries could see them. But there was nothing that accelerated the crisis dynamic. So there's been a long amount of time for negotiation. And as a result, most things have played out over the past 6 months in a fairly predictable way. Sri Lanka was predictably heading towards a default. Pakistan predictably needed financing. Egypt and Ghana predictably need financing. And at least so far, there hasn't been a big surprise. But the longer bond markets stay tight, the more commodity markets stay volatile, the more banking systems are placed under strain because they have to help cover financing gaps, the more risk is that there'll be some additional surprise.
My last question for you is kind of just our traditional question. Is we know that there's a lot of debt managers around the world listening to this podcast, as well as all sorts of policymakers and students and and the like. But to those debt managers that are listening, do you have any parting words or advice or any words of wisdom for them? Sorry to put you on the spot, but there you go.
And the clear lesson of the past 2 years is that big spikes in payments on external hard currency debt leave you with no choice. You will either have to have an IMF program or will end up in default and be pushed into a framework defined by the collective will of your creditors. The old-fashioned lessons about managing your external repayments profile extremely carefully and maintaining an adequate cushion of reserves are actually like the old wisdom is really still the right wisdom. What we've seen is that spikes in external amortizations are the real source of most current sovereign distress. Though there may be periods in time when some of the risk associated with foreign participation in local bond markets becomes a more important driver of near-term distress. But the lesson of the past few years has been that the hard currency debt really can sink an economy.
Well, we'll have to have you back on to talk about the domestic markets and how all of that also kind of fits in going forward. But
there's an interesting set of questions actually around Zambia because a non-trivial part of Zambia's external debt and an increasing part in the period of Zambia's external default is now foreign participation in the local market and is being excluded from the restructuring. Rightly so, but that has a set of consequences for the debt service calculations that will define returns. So.
No, absolutely. And some of the other cases you mentioned, it also plays a big and increasing role in these workouts. So, but like I said, we're up against time, and I just want to thank you so much, Brad, for being with us. It's a real pleasure. Thank you.
No, thanks for the opportunity. It's fun.
Thanks for listening. If you enjoyed the episode, leave us a review and subscribe to the show wherever you get your podcasts.